Welcome to today's webcast. Before we begin, let's quickly go over how to get the most out of this session. Your main player area consists of 3 windows: video, slides, and a multifunction window underneath. Each of these windows can be moved, resized, maximized, or even closed. If you like to return to the default layout, simply click the Restore button on the bottom of your screen. The multifunction window is where you'll find some helpful tabs like questions and answers, an area to download any available materials, and speaker bios. You can also turn on closed captioning by clicking the CC button in the lower right-hand corner of the video player. KPMG has been approved by NASBA to deliver CPE-worthy training. Today's CPE will be tracking your participation through polling questions, which will look like this. In addition to attending the entire session, you must answer these polling questions throughout the webcast. Your presenter will audibly address the polling question each time one of them appears. Your participation will be tracked, and failure to actively participate will result in denial of CPE credits. If you have any technical issues during the webcast, please submit a question through the question and answer panel, and our producers will respond to you directly. Please submit all content questions through the questions and answer panel as well. Thank you and enjoy the webcast.
Hello. On behalf of KPMG, welcome to today's event, Clean Energy Tax Incentives for Tax-Exempt Healthcare Organizations. With recently released guidance on the energy credits, including direct pay and transferability, we promise to bring you a great program. My name is Lori Robbins, and I serve as KPMG's National Tax Industry Leader for the Healthcare Tax Practice. It's my pleasure to moderate today's session. For anyone who joined late and missed the CPE video that just played, this session is CPE eligible and participation will be tracked through a series of polling questions throughout the session. In order to receive credit, you must attend and remain logged on and respond to all of the questions. You will receive your certification via email approximately 2 weeks following the event. For technical assistance, if you have any technical issues during the webcast, please use the questions and answers panel on your screen. When the webcast ends, please do not close out of your browser completely. The player will automatically refresh to display an exit survey. Now on to our speakers. First, we have Hannah Hawkins. Hannah is a principal in the Washington National Tax Credits and Incentive Practice, where she advises on technical issues related to the energy industry. Before rejoining KPMG, Hannah served as the Deputy Tax Legislative Counsel in the Treasury Department's Office of Tax Policy. At Treasury, she was involved in virtually all aspects of the domestic and regulatory agenda and led the development of guidance and internal policy making on tax issues associated with renewable energy, oil and gas, and utilities. Next, we have Preston Quisenberry. Preston is a managing director in the Washington National Tax Exempt Organizations Practice of KPMG. He has more than 15 years of experience advising tax-exempt organizations. Prior to joining KPMG, Preston served as a special counsel in the Tax-Exempt and Government Entities Group Division of the IRS Office of Chief Counsel, where he helped draft numerous Treasury regulations and other published guidance items affecting tax-exempt organizations. He currently provides tax advice to hospitals and other tax-exempt organizations across the country on a wide variety of tax issues. And last but not least is Ian Tester. Ian is a managing director in our infrastructure advisory practice. With a background in civil engineering, he specializes in project finance, procurement, option analysis, comparative risk assessment, proposal evaluation, and contractual obligations. Ian has 20 years of experience serving the public and private sector infrastructure clients. Moving to the agenda, we will first do a brief overview of the credits and incentives, understanding that many of you already know the basics. We will highlight recently released guidance in areas of focus for the healthcare sector as well as tax-exempt organizations generally. Ian will discuss the journey an organization takes from conceptually defining its energy strategy to realization of a clean energy project. We will end with Q&A as time allows. Please feel free to submit content questions at any time throughout the webcast by using the questions and answer panel on your screen. Thank you again for joining us. And now I'll turn it over to Hannah to get us started.
Thanks, Lori, and good afternoon, everyone. Happy to be speaking to this audience on this topic today. Since the Inflation Reduction Act passed almost a year ago, I've been spending pretty much all my time sort of understanding the provisions of the Inflation Reduction Act and helping clients navigate these provisions. So it's been busy and a lot of fun, and we're excited to continuously provide updates as we get more guidance on many of these provisions. So looking forward to the content today. So let's start with a little bit of background. So energy credits have been around for decades. The tax code has been used, for years as a sort of policy driver for different energy policy initiatives. In particular, renewable energy. So for years, there have been various tax credits in the code available for certain investments in certain technologies. For example, wind and solar have been, big beneficiaries of tax credits in the Internal Revenue Code. And all these tax credits under prior law, so pre-Inflation Reduction Act, were either, they were actually starting to phase down statutorily in many cases, and they were all non-refundable and non-transferable. And through cross-references to other provisions in the code, specifically Section 50, there was very limited ability for tax-exempt entities, both government and tax-exempt organizations, to use these tax credits. Either you couldn't altogether, or you could only use them to offset unrelated trade or business income. So it very, very limited applicability to tax exempts. That's why you would often see tax exempt organizations, not own directly energy property. If there was going to be solar that would be used by a tax exempt entity at their, at a facility, a third party taxable entity would typically own that solar, and the tax exempt entity would have a power purchase agreement or service agreement or something, with that taxable entity, because the taxable entity could use the tax credits and could use the depreciation, while the tax exempt could not, but still wanted to, make these commitments to renewable and cleaner power. So that was the lay of the land prior to Inflation Reduction Act. And so let's go to the next slide. What we got in the Inflation Reduction Act were a whole bunch of changes to this space. So we got, various enhancements, modification. I noted that a lot of these credits had been phasing down. So instead of having phasing down credits, we now have extended credits, in many cases enhanced credit rates. Brand new credits were enacted as part of the Inflation Reduction Act for technologies and equipment that was not, previously incentivized by tax credits. Also new requirements in order to get access the highest available credit rate in some cases. And we'll talk about that in a little bit more detail. Those new requirements relate to the types of labor you use to construct these projects. Also bonus credit opportunities in some cases for these credits. Bonus credits for things like the type of components, like if the components you use in your products are domestically sourced, and where your project is located. And then, and this is what we'll spend a good bit of the time today talking about, is a new direct pay election that was provided in the Inflation Reduction Act. And so what direct pay does is, so, I mentioned before that all these credits were non-refundable, non-transferable prior to the Inflation Reduction Act. What direct pay allows is for a tax-exempt and governmental entities can make an election. So if they own the eligible property, they can make an election to treat the credit that they would otherwise be eligible for as a payment of cash. So essentially a refundable tax credit for certain tax-exempt entities. And it turns off those provisions that sort of disallowed the credit for these entities under prior law. And this is effective for tax years beginning after 2022. So I'm going to pause on that point because it's important here. Because if you're a tax year beginning, July 1st, but you placed in service credit eligible property in February of 2023, then you cannot make that direct pay election for that property. It has to be, for the tax year, first tax year beginning after 2022. So just heads up on that. It can trip up, and we've seen it sort of, potentially trip up some fact patterns here. So important to keep your eyes on the date, as always. And so another clarification that's important to understand about the direct pay election is, it treats the credit determined, that is the credit eligible property that is owned by the tax exempt entity. It treats that property as owned and used by a trade or business of the tax exempt entity. So, a lot of these credit provisions refer to, and it's a requirement for eligibility for this property to be held and used in trades or businesses. And so it's important to understand that, what this provision does is treats it as if it's held in trade or business, such that for these tax exempt entities, you are eligible for the credits. And you can also, access the capitalization rules that are available to taxable entities. And that is how you determine, your eligible basis for many of these credits. And those under sections 263 and 263 Cap A. We won't do a deep dive into capitalization methodologies here, but just important to know that, this is a concept that is very typically and commonly, applied to sort of investment tax credit type concepts, depreciation type concepts. And many tax exempt entities have not had to think about these concepts before, but they apply here to the credit eligible property owned by tax exempt entities. So moving on, so under the statute, under new section 6417 as enacted by the Inflation Reduction Act, it says that certain applicable entities are eligible for this direct pay election. And in the statute, those entities are entities exempt from tax, states or political subdivisions thereof, the Tennessee Valley Authority, Indian tribal governments, Alaska Native corporations, and rural electric cooperatives. So those are the specified applicable entities in the statute. Now go on to the next slide, please. Now, the proposed regulations that we got last month, provided some clarifications on this list of applicable entities that was provided in the statute. So it made the clarification that agencies and instrumentalities of the state are included in the list of applicable entities. That had been sort of one of the big questions that people were looking to propose regulations on the direct pay election to provide clarity on. Many thought it was sort of a drafting error or an oversight that instrumentalities were not explicitly included. So it was a good clarification that was included in these proposed regulations. And I should add, I didn't note this at the top, but the proposed regulations I'm talking about were the proposed regulations that were issued last month, sort of end of June, specifically on new section 6417, which is the direct pay election, and new section 6418, which is a transferability election that was also provided in the Inflation Reduction Act. But more on that later. I just want to level set on when I'm talking about the proposed regulations. That's what I'm talking about. Okay, so let's keep going. And another issue that had been sort of top of mind and on which much speculation had been made was this concept of mixed partnerships. So one question was whether a partnership that consisted of tax-exempt organizations and taxable organizations could own credit-eligible property and make a direct pay election or make a partial direct pay election, just for the tax-exempt partners. And the answer is no under the proposed regulations, that partnerships are not applicable entities. Even if all the partners in the partnership are applicable entities, the partnership is not. So that's important because we have gotten lots and lots of questions about, I'm going to make this investment in a joint venture with a taxable entity. No, it cannot be a partnership that makes the direct pay election. So That is, a open question that was answered by the proposed regulations. Whether or not that rule will evolve or be, the exceptions provided for in final regulations remains to be seen, but the proposed regulations say no. Now let's talk about some of the credits that are probably most applicable to this audience that are included in the Inflation Reduction Act that now have this direct pay option. And so under the credits that were sort of existing under prior law, but modified by the Inflation Reduction Act that we're going to talk about include the alternative fuel vehicle refueling property credit, which is a mouthful and another way of saying charging station credit. And then the Section 48 energy credit. And that's the credit. I mean, the Section 48 credit, investment tax credit, has been around forever and it's used to incentivize almost everything. But as it currently exists, it incentivizes things such as solar, geothermal, cogeneration. We'll talk about some of those equipment and some of those opportunities in more detail, but that is among the credits we'll highlight today. And then among the new credits that were included in the Inflation Reduction Act, you'll see here is quite a few. So credits that didn't exist under prior law and have been created to incentivize sort of brand new technologies in many cases. So it's a very, very exciting piece of legislation for, innovation. But highlighting here for this audience as most relevant, we'll talk about Section 45W, which is the new credit for qualified commercial clean vehicles. And then Section 48E at the end there that's what the investment tax credit that we'll talk about sort of transitions into. And can we back up a few slides? Thank you. One more. Oh, no. Okay. Advance, please. Sorry. Okay. And so what are the mechanics of making a direct pay election? So a direct pay election must be made on an original tax return, including extensions. It cannot be made on an amended tax return. And there will be a pre-registration process. So you'll have to pre-register your credit eligible property. And this will be on a IRS portal that is not yet available yet. So the proposed regulations provide this requirement that you have to pre-register before you can claim your refundable tax credit, essentially. But this IRS portal through which you'll have to do this registration doesn't yet exist. We've been told, and they say in the proposed regulations that the portal will be open in October. So more to come there, but there will be a pre-registration requirement and you will have to submit certain information about your credit eligible property. And there is a potential penalty if you claim more credit than more payment than you are eligible for. In such case, you would have to pay back the credit amount plus 20% penalty. But there is a reasonable cause exception to that. So if it was the proposed regulations didn't provide a lot of information on this, but if the excessive payment claim was as a result of a calculation error or something like that, the thinking is that you won't have the 20% penalty. So let's go to the next slide. And we're not going to talk about this in detail, but the other monetization feature in the Inflation Reduction Act was transferability of tax credits. And so eligible taxpayers for purpose of transferability of tax credits typically does not include applicable entities. And those are the entities that are eligible to make a direct pay election. So just putting that there, when people talk about the Inflation Reduction Act monetization options, it's direct pay and transferability, but transferability has probably limited applicability to this audience. But a lot of the same sort of mechanical rules apply, including those for like excessive transfer amounts and registration requirements and things like that. So here we're going to pause with a polling question. So as part of an ESG strategy, is your organization currently in the feasibility, planning, or construction phase of a clean energy project? For example, solar panels, geothermal, lighting, or heating, cooling upgrades, electric vehicles, and charging stations, etc. Looks like it's early days for many of you, but on the horizon. So a good time to be having this discussion. Great, and we can move on whenever this has been up long enough. So now with that background, I'm going to talk a little bit about some of the relevant credits that I highlighted earlier. So the first is the investment tax credit under Section 48. So the investment tax credit is a one-time credit equal to the percentage of your eligible basis of the energy property placed in service. So again, you take your ITC eligible basis, which remember, might invoke capitalization principles under 263 Cap A to get to that correct basis amount. Then you multiply it by your ITC percentage, which is up to 30%, but can be as low as 6%. And I'll talk about that in a minute, but it's the 30% is the highest amount, not including various adders. And then you get your investment tax credit amount. And that is the amount you will treat as your credit that you're otherwise eligible for, treated as a payment of tax for which you would get a refund. So that's the basic mechanics of the investment tax credit. Let's move to, so the investment tax credit as it currently exists has specific eligible categories of energy property. And again, sort of most relevant to this audience would probably be solar, combined heat and power systems, cogeneration systems, geothermal heat pumps, maybe energy storage technology that was newly added to the investment tax credit under the Inflation Reduction Act, fuel cells, micro turbine power plants, microgrid controllers. So again, these are all the eligible technologies that are for which an investment tax credit is available. And when the investment tax credit sort of phases out, so the investment tax credit as it exists now with the different eligible categories of technology, you have to begin construction prior to 2025 on that type of property in order to be eligible for the investment tax credit. So that sounds like a short window, but it isn't, because for what happens after, sort of what the new regime after the existing investment tax credit is Section 48E, which is a tech neutral investment tax credit. So 48E is available for property that is placed in service after 2024. And what I mean by tech neutral is that it can be any electric generating property as long as it creates zero emissions in its generation. So that does raise some questions about, whether all the technologies that are currently eligible for the investment tax credit will be eligible for the tech neutral tax credit, specifically cogeneration. There is some combustion of natural gas in that process and with emissions. So it potentially doesn't have the same eligibility, but we need more guidance on how this is going to be calculated and to understand it. But solar, for example, will have zero emissions. And so you should be eligible for the same level of incentive that you would under the current law. And then just some requirements, general requirements under the investment tax credit. Again, you have to begin construction prior to 2025. There is a lot of guidance on what it means to begin construction. We could spend an hour on that. I'm sure nobody wants to, but there is specific tax guidance about what it means to begin construction in that context. You have to be the original owner of the equipment. You have to place it in service in order to be the credit claimant. And again, the credit is generally 30%. If you meet the prevailing wage and apprenticeship requirements. If not, the credit is only 6%. So, and there's these additional bonus credit opportunities that we'll talk about in more detail. The credit rate can be reduced if tax-exempt bond financing is used to finance the project. And then there's also a rule in the proposed regulations on direct pay that would reduce the credit if property is acquired from income that is exempt from and received for specific purposes, exempt from tax and received for specific purposes. So important flag there that, this rule I think the policy is to get it, try not to over subsidize in this space, but I think maybe that rule is something that people have to spend some time with to better understand how it applies. And then I keep talking about these bonus credit rates. So the difference between the 30% and the 6% investment tax credit depends on whether you meet prevailing wage and apprenticeship requirements in the on-site construction of your project. So it's not that your solar panels have to be manufactured in the US. It's that they have to be installed on site using prevailing wage labor and qualified apprenticeships. If those requirements are satisfied, you get a 30% investment tax credit. If they aren't, it's a 6% investment tax credit. So it is a very, very big difference. And just flagging here that it's not enough to just have your contractor say, yeah, of course we're using prevailing wage labor. You're going to have to, the documentation burden is on the entity that's claiming the credit. So you're going to have to be comfortable that you can document that you have met prevailing wage labor. So very, very important because the credit rate difference is obviously material. And then the adders. So say you do meet prevailing wage requirements and apprenticeship requirements, and you have a 30% investment tax credit, there is an opportunity to get even more credit. So if you do procure, if your solar panels for your solar project, your example solar project, were manufactured in the US, and the steel and iron used in the project are manufactured or sourced from that in the US, that could meet the domestic content requirement and could get you an extra 10% investment tax credit. So a 40% investment tax credit. And then there are other credit enhancements specifically for energy communities. That's brownfield sites. So if your project is located in a brownfield site or area formerly reliant on coal and fossil fuel industries, there is an extra 10%. So if you meet prevailing wage, if you meet domestic content in your energy community, potentially a 50% investment tax credit. And then there's also another environmental justice allocated bonus credit that you have to apply for that is up to another 20%. So, if the stars align and many things go right, potentially a humongous credit. I think it's probably unlikely that projects would hit all of those boxes. But just putting it out there that there are these other opportunities to increase your credit amount. So going back to sort of calculating your investment tax credit, again, one-time credit, eligible basis times your investment tax credit amount. And as we just discussed, that investment tax credit percentage can be 6% or it can be 30, 40, 50%. And then you get your ITC eligible amount. So, it sounds simple, but obviously, as I just walked through, there are various moving parts in trying to make these calculations work, including determining your eligible basis. And that many times will require, to do this right, a cost segregation analysis. Then now I'm going to talk for a few minutes about some of the vehicle and related sort of charging credit opportunities. And as I talk through these here, I think I would like to invite my colleague Ian to join me. So first, a new credit available that I've touched on a little bit is the commercial clean vehicle credit. And this is up to 30% of your investment in clean vehicles that you would be using for your organization. So that could be trucks and buses. It's also incentivizes mobile machinery. That's one thing that we're still waiting for additional guidance on is, what fits into that mobile machinery category. But we're definitely getting a lot of interest in this credit, sort of across the board, from all types of entities, but certainly from tax-exempt organizations. And I don't know, Ian, if you can share any knowledge in this space.
Yeah, really. Thank you, Hannah. So just as by way of background, so I work with a lot of public agencies and infrastructure owners in the higher education space and in the not-for-profit space more broadly. And a lot of them, while historically they've been used to building buildings and other pieces of equipment, this tax policy is affecting the way that they think about the other elements of their physical assets and portfolio, and that includes thinking about if they have transit operations, thinking about how they procure new transit vehicles, thinking about, you Hannah spent a lot of time discussing energy and energy credits, thinking about the types of technology, geothermal, that they can add to their mix and add to their overall supply side mix, while also thinking about how their demand can be mitigated as well. So thinking about that seesaw, that teeter-totter, what that balance looks like. And then not to forget, the EV charging in the kind of infrastructure that this audience likely has. There's probably a lot of assets that are brought, vehicles that are brought to a place and are sitting for a good few hours. The ideal opportunity to be able to leverage that around EV charging and bring that into the mix of services. So we do see with our public owners, public infrastructure owners, this infrastructure sale, if you will, through tax credits, really starting to have an impact in the market.
Yeah, it's been really interesting. And let's skip ahead to not this and one more slide so we can talk about the charging station. So as Ian noted, of course, if you're going to green your fleet, you have to also sort of invest in corresponding infrastructure to support those investments. And the way that the tax code incentivizes that is through the Section 30C tax credits. This is the charging station credit. So great, right? This makes perfect sense, and it sort of drives policy in the way you would expect. But note that what is a change that was made to this credit under the Inflation Reduction Act was that it is only available for charging stations located in census tracts that are low income or non-urban. So, sort of an overriding policy there on sort of, getting charging stations to where they need to be, maybe, is what's happening with that policy. But so, yes, of course, people are making these investments and making these decisions, but just be careful to know that there is a charging station credit, but it might have limited availability. Okay, another polling question. In the next 3 to 5 years, does your organization plan to make energy efficient upgrades to current infrastructure? For example, lighting, HVAC, windows, etc. So it looks like a lot of the respondents are thinking about these types of upgrades and investments, which makes sense and segues nicely into the final topic that we'll discuss under the sort of the tax incentive heading of this presentation. So this one isn't a credit. This is a deduction. Section 179D, energy efficient commercial building deduction. And this is another one that has been around for several years. And there was always a provision under 179D that government-owned buildings, government-owned buildings, government entities that are making investments to upgrade the energy efficiency of their government-owned buildings, they could allocate the deduction to the designer of the property. So that has been a provision in Section 179D for years. So what the Inflation Reduction Act does is not only does it increase the potential available Section 179D deduction amount, potentially up to $5 per square foot, it also broadens the category of exempt entities that can do this allocation of the deduction. So not just government-owned buildings, but tax exempts broadly. And so I should note, though, to get to that $5 per square foot, you do have to meet the prevailing wage and apprenticeship requirements I talked about. So that's sort of woven throughout most of this. But so there is this opportunity that you can contract to have these energy efficiency upgrades made to your buildings, either retrofitting a building or a brand new building, and you can pass that deduction along to your designer. And the sort of policy there is that the entity, that tax exempt entity, should be able to realize some economic benefit of passing that allocation to the designer. In commercial practice, I think it varies how this works, but that is the idea. So it's important to know about the ability to first be eligible for that deduction and the ability to pass that deduction along to a designer while you're planning and contracting for this type of work. So with that, I think now I pass it off to Preston to talk to some of the exempt org tax considerations specifically.
Yeah, thanks, Hannah. And just building off that last slide on 179D, given that the main incentive there is really, tax exempts are usually not going to be able to avail themselves of the deduction. So the idea is that you could pass it on to the designer, and the potential benefit to tax exempts is really in the lower price that they should get as a result of being to pass on that deduction. But in order to actually get that benefit of the lower price, it's really important to take into account Section 179D at the outset of the negotiation process, really even at the RFP, request for proposal process, to make clear that it's anticipated there'll be this benefit, so that can be taken into account into the pricing for the project. If conversely, the designer just comes to you as a tax exempt hospital, after the project is finished and say, hey, sign this so I can get the benefit of the deduction, the sole benefit, you as a tax exempt hospital didn't really benefit from that at all. And B, it does raise certain questions about, well, can you really just pass this benefit on to a private party? Because as this slide gets into, as a tax exempt organization, there are all the usual considerations that will come into play as a tax exempt organization that tax exempt hospitals and other tax exempts have to consider in all of their activities and all of their transactions, including those involving these various clean energy projects. And those sort of typical considerations that come into play are listed here. That and as private inurement and private benefit, particularly when you're engaged in transactions with private parties, are always going to be something that you need to consider. You need to be, to ensure that you're operating exclusively for exempt purposes. UBIT is another concern if the tax exempt is actually going to be selling anything, whether goods or services. In this case, possibly if they're selling clean energy or selling access to various e-charging stations. And we'll maybe touch on that in the next couple slides. The one other thing just to note on the prior slide is the Form 990 and Form 990Ts, where the credits will be reported. Those are public, and lots of practitioners that may be used to dealing in the credit space just on the taxable side may not think of that. That hey, this unlike with the taxable where their tax returns cannot be publicly disclosed, with tax exempts everything's publicly disclosed. So you need to be sensitive to that as well and engaging in these transactions. So if we can go to the next slide. I think in a lot of cases with a lot of these projects, tax exempt hospital or other tax exempt healthcare organization is typically going to be looking at projects to generate energy for its own use and carrying out its own exempt purposes. And if that's the case, as long as there's not any inurement or private benefit going on, that should generally be an activity that furthers the exempt purpose of the tax exempt. And it would also, if you just have one entity in a system of related entities, say in a hospital system context, it's okay for that one entity to be the generator of power for an entire system. There's regulations that are cited here that make that clear. I think where things get a little trickier is when you're generating power that is going to be sold or otherwise provided to unrelated parties. And unrelated parties is somewhat of a term of art. If you're actually talking about a tax-exempt hospitals, if you're talking about its patients or its employees, there is this exception under the unrelated business taxable income rules called the convenience exception, where oftentimes if you're selling certain items to those categories of individuals, such as parking, a common example with patients are things like lab testing, pharmaceutical sales, et cetera. Those are those fall under this convenience exception and are not subject to UBIT. And you could see if you're talking about selling EV charging, for example, to certain patients or employees, and while their cars are parked in parking lots and they're receiving treatment, that all may fall with under the convenience exception. And that convenience exception does apply regardless of whether the charging facility is debt financed or not. I think where things get trickier is when you're selling to parties that are not patients, are not employees, they're not related organizations, they're just unrelated. If we go to the next slide, that the environmental protection and preservation, it has been recognized as a charitable purpose, but the available authorities on that as a charitable purpose are relatively few. And there are hardly any that really address clean technology where the main environmental benefit is trying to address climate change, reduce emissions, et cetera. And if you layer on top of that the possibility of engaging in commercial exchanges where there's always a question of, is the commercial purpose really primary and the charitable purpose just incidental? Or if there's potential private benefit to other parties, that certainly makes things more complex in the analysis. So the short story here is that you can't just assume just because it's clean technology that, hey, it serves a charitable purpose and we don't have to worry about UBIT. If we go to the next slide, a couple of final observations here. One is a tax-exempt organization, they can actually buy these credits, just like any other party can buy credits from non-applicable entities, that is eligible entities that are eligible to sell them. But when they buy those credits, they can't then turn around and make a direct pay election and get a direct pay refund. They can use those credits against their UBTI liability or their UBIT liability, but they can't turn around and sell them. The proposed regulations made that clear. And I guess assuming that the proposed regulations are finalized as is, that resale would not be possible. Another thing that the proposed regulations address are certain clean energy projects that are financed by a grant, a forgivable loan, or other income that's exempt from tax. That's what the proposed regulations call a restricted tax-exempt amount. When you've got those grants, forgivable loans, otherwise exempt income, that's for the specific purpose of purchasing, constructing, reconstructing, erecting, or otherwise acquiring certain investment-related credit property described in all of the code sections I think tax-exempt hospitals will be most interested in. This 30C, 45W, 48, 48E, for example. If you've got that, what the proposed regulations would say is you can include those amounts in the basis of the project that's used to determine the credit. But in certain instances, if you look at both that restricted tax exempt amount and if you look at the credit that you would otherwise be eligible for when you compute it, if those two amounts together are more than what the cost of the project would be, you need to reduce the credit amount so that those amounts are equal. And I know that's somewhat of a mouthful. We could go through some examples, but we're running kind of short on time. I think if you look at the proposed regulations, they do have some helpful examples that show you how that restriction on credits would potentially work. And it's worth thinking through your own fact pattern, whether you're expecting funding through restricted tax exempt amounts, and if so, to comment on those provisions, because these regulations are just proposed, and if you foresee issues with that, it's worth letting Treasury and the IRS know. So I think we have got a polling question next. Has your organization's board asked about the IRA's new clean energy incentives and their relevance for your organization yet? Yes, no, or not sure. Looks like we've got not sure is the largest, followed by no. So So boards do not seem to be an active part of the process yet for many of you. So I will turn it now over to Ian.
Thank you, Stephen. So I'm going to spend a couple of moments here as we get to the back end of this call and this webcast to maybe sketch out a journey. We've heard a lot this afternoon, a lot of detail about tax, about deductions, about credits, about grants, and how does one bring that all together? How does one start the process to think about some of the projects or some of the change, the energy transition change that your organization might be thinking about? And that's where our group within KPMG, working alongside our tax partners, can help you facilitate that conversation. Hannah mentioned making stars align earlier on, and this ultimately is about this process we've outlined here is ultimately about increasing the probability that those stars will align to 100%, hopefully. But it begins really with, for example, as we think about energy strategy, understanding what that vision is. For example, I know we have clients who have a lot of real estate and are being maybe bombarded is too big of an adjective, but nevertheless they have received many unsolicited proposals and knocks at the door about, with vendors looking to provide these kind of services to them. Having a framework and a strategy around which you can go to the market and solicit those services in a way that is maximal, provides maximal advantage to your entity. Hopefully, it is fairly obvious, but clearly enhances your chance of success. Equally, as you move to the right here, understanding what the lay of the land, the current state, with respect to how much you are spending. And I know the audience here is much about tax, but thinking about within your organization more broadly, what you plan to spend so that you can identify and frame out the analysis of options around a cost over the full life cycle. So we've talked about a lot of the benefits which become in certain tax in tax forms, but clearly that's only part of the capital stack. Understanding how you bring that full sources of capital into the mix is important. Increasingly we're seeing financial providers in the way that they have done in other sectors of the market, providing bridging or gap finance, factoring to some extent, the credits or the grants that might be available down the line to be able to kickstart this work. Having an understanding of what that means for you, being able to drive those conversations with the knowledge of what options are out there, really it helps to enhance the accretive value of a lot of the tax credits and grants that we've spoken about in whatever domain that you are looking to drive. Again, as we move further to the right, we often help clients think about the way that they deliver these projects. So implicit in our conversation today has been the notion that the tax-exempt organization goes out and delivers this work itself. Ultimately, it's responsible for it, but are there packages of it that can be farmed out? For example, the design, the build, the finance. You may wish to operate the assets yourselves, but does that really maximize the opportunity around, for example, EV charging? Presumably not. It is a business that many people are new to. It continues to evolve. Being not at the bleeding edge, but the leading edge, I think is probably important, and having a team with you that can help support and understand those options are going to be critical. And then as you move into the back end around program governance and development of that contractual monitoring, the other piece of the story that you've heard today is, the carrot is infrastructure on sale. The stick is there are a bunch of requirements that the feds come back to with around Buy American, prevailing wage, that you need to be on top on. You need to have program controls, program governance and oversight that allow you to monitor and execute. So really, as you move from the left of this slide, understanding what it is today and understanding where you want to be in the future are key parts of that story, and then having a framework, a governance framework around which you can measure your involvement, measure the various requirements that come with some of these tax advantages is going to be critical to those stars aligning. So that's in very quickly. That's a summary of some of the clean energy transformation process that we see in these areas where very often a health system is used to buying infrastructure in a certain way, and there are new tools that are available. And some of those new tools mean that you need to make tweaks to your overall processes. So I think we're going to move to the right now and have a polling question. And the question is clean energy a priority in your organization's sustainability and ESG strategy? Thanks to you to all who are still paying attention. And it seems like the vast majority so far seem to be in the yes category, and way over in the majority of the group overall. So with that, I think we're going to move to Q&A. And I think, Laurie, I'll hand it back to you.
Great, thanks, Ian. Appreciated that. We have time for a couple of questions that have come in from the audience. One of them that I want to throw open to the group, and this came up when Hannah was discussing the direct pay election. There were a couple of questions about the process for the online pre-filing registration, what the process looks like, when the IRS portal, I believe, Hannah, that you mentioned is projected to be available. I don't know if you want to take that question or if Preston would prefer.
Sure, I'll talk a little bit about it. So yes, as I mentioned, there is this pre-registration process, although it's not yet live. It's been indicated that it will be open in October of this year, so October of 2023. And we do know that in order to register, you're going to have certain information like the location of your project, its cost. So maybe that could be a cost segregation report or something similar, something summary report, beginning of construction dates, placed in service dates, things like that. And you cannot make the election without doing this pre-registration. And I guess what we don't know is sort of how long it will take, because you're supposed to register and get a registration number that you would then put on your return when you're making that election. And we don't know how long any of this is going to take. Obviously, this is brand new. So I think we're getting some good questions and some valid questions about like, well, what if it takes a month to register and then get the registration process? What am I supposed to do? So hopefully we'll get some interim guidance or some guidance in connection with when that registration opens to answer some of these questions. And a question that wasn't asked as part of what Lori posed, but is a question I get in connection with this is, well, how long, say I do everything, I register, make my election, I file my return with my election, how long will it take to receive the funds? How long will it take to get the refund? The proposed regulations, although it was, there were lots of comments from stakeholders in advance of these proposed regulations asking for mechanisms to expedite that payment. The proposed regulations say no, you can't get it. You can't get your refund amount any earlier than, after your return has been filed and your refund is processed. And we don't know how long it's going to take to process that refund. Hopefully, hopefully, one of the functions of this pre-registration process will be to speed up that refund processing. They'll have some information in advance that they wouldn't normally have when they're processing refunds. So, hopefully that's part of what this registration process is about. I mean, obviously it's also about fraud and abuse and duplication of credits and things like that. But, there is this still open question about, okay, fine, if this process goes as planned, what is the timing of the payment, which is obviously really important.
Right. And you mentioned, Hannah, I think the opening of the portal, and I thought, am I correct in hearing you that you said probably October is at least when the IRS is projecting that it will be available? I mean, obviously they're building it, right? So yeah, you never know necessarily with when you build a system, whether it's going to work out as nicely as you want it to.
I mean, I think we can assume that they're well aware of the pressure on timing, right? I mean, they can't get this out end of year. They can't get it out early 2024. It has to be sooner than later this year. So hopefully they'll deliver.
We'll wait and see. I'm sure there'll be an announcement, and I definitely guarantee we will get that information out to clients as quickly as we know it.
Yes.
a couple of other questions with respect to commercial vehicles. Mentioned the new credit for commercial vehicles. What does that cover? I mean, I assume it would cover shuttle buses that circle a healthcare campus, and maybe the fleet of trucks that a maintenance department would have. But what about patient shuttles, motorized carts for small numbers of patients? Does it cover all of that as well? I mean, can we take an expansive view of this, or?
I think we're still waiting on some IRS and Treasury clarification of the breadth of Section 45W. What we do know is that, motor vehicles, trucks, shuttle buses, stuff that operate on roads, those types of electric vehicles will qualify. What's less certain is there's this other category of mobile machinery, although specifically, explicitly included in the statutory language. There's some question about how it all fits together with the rest of the statutory requirements. Specifically, there's a requirement that the vehicle must have been manufactured primarily for use on public roads. So there can be a question about what types of vehicles do fit into that category. And there's also a requirement that a vehicle has a VIN number. And there's a lot of things that would, logically go in a mobile machinery bucket that might not have a VIN number. So just some open questions about what fits into all the buckets of 45W eligible categories.
Great. Okay, that's helpful. Obviously, these are proposed regs, and we'll probably get some feedback on those through comment letters, et cetera, correct?
Laurie,
well, on 45W, we don't have any guidance yet. So we're still waiting for...
So we're still waiting on that.
Sure. It probably will be an iterative process, too. Yeah.
Okay. I know.
Sorry. I think I talked over Ian. Sorry about that.
Yeah, Laurie, if I can just jump in just quickly still on the EV charging infrastructure. I think there's a question about mapping. Within our infrastructure group, we've developed some. I think the question was in terms of where EV charging relates to low income, and I think there's definitely a lot of data out there, and we've done quite a bit of work on stitching some of those data sets together to provide a tool that can start to look at down at the zip code level, where US DOT, the corridors, current EV registrations, where current charging assets exist, all the way through up to energy infrastructure data, where how you can meet power and where power requirements are, allowing folks to be able to sort of dial in their needs and understand a little bit the gaps that currently exist and where therefore the opportunities are too. So we started to bring together those various data sets in layers that can help, as they integrate where you are today, what future EV charging demand might look like, and then some of the more tactical stuff about how you make that charging infrastructure come to life with an energy supply and what that might look like too. So there are some tools out there, but unfortunately not in a single place.
Okay. So not a quick and easy answer for the low income.
No, unfortunately, it never is sometimes.
Yeah. Okay. Great. Thanks, Ian. I know we have a number of other questions, but we're out of time and need to wrap up for CPE. If you asked a question and it was not answered, someone from KPMG will be in touch with you. We also have our contact information here on this slide that you see on your screen, so feel free to reach out to any of us at any time. Thank you very much for joining. The healthcare sector is very important to KPMG, and we look forward to bringing you additional support and programming soon. A replay of today's webcast will be available soon on the KPMG website. Feel free to share this information with your colleagues who weren't able to join us today. When the webcast is over, please again do not close completely out of your browser. The player will be refreshed to display an exit survey. If you meet the CPE requirements, you will receive your certification shortly. Thank you and have a wonderful afternoon.